So explain to us about the terminology that's going to be used and some of the hurdles they have to overcome.
Okay. Firstly, you're going to hear terms like P.M.I, which stands for private mortgage insurance. L.T.V is loan to value, which covers the amount that you're borrowing in reference to or versus the amount of the total
Let me
project.
stop you there. So LTV stands for like if someone needs to bring 5 or 10 or 20% down to avoid PMI, that's considered LTV?
Correct. So if they're building a house, let's just say the total project costs $300,000 and they have $50,000 to put down, they would be borrowing $250,000. So that's a percentage, or the loan $250,000 versus the $300,000
On a 20% down.
Correct.
Okay. And you mentioned PMI and LTV. Those two terms actually kind of go together hand in hand a little bit because you need PMI if your LTV isn't at 20%, which
Correct.
is loan to value. But before that, your very first hurdle you mentioned was credit worthiness. So
Correct.
that's going to be the first hurdle. Somebody needs to have good credit.
So think about it as a race, a hurdle race. There's 3 hurdles in this race. The first hurdle would be your credit worthiness. So we would run your credit and see where you fall as far as good credit, or maybe there needs to be some improvement to qualify you. The second hurdle would be your debt to income ratio. So we look at what you make gross monthly versus your current expenditures. So student loans, auto loans, revolving debt, and the new proposed house payment.
Is that the DTI?
Correct.
Okay.
So, and then once we get over that hurdle, then we go into the having sufficient funds for closing, which would consist of your down payment and your closing costs.